Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, PolarFuturesGroup.com. Welcome back to the show, Victor.
Jim, it's always a pleasure to talk with you.
Victor, for the last 3 weeks on your PolarFuturesGroup.com blog, you've been writing about the September 3rd key turn date. You think that long-term interest rates may have made an important turn higher on that date. And if that's true, then everything changes. Can you explain what you mean by that?
Well, yes, I think I can. I've been really fascinated here for the past month or so by what happened on September the 3rd. So one of the things that happened was that the yield on long-term U.S. Treasury bonds made its all-time low that day. It was about 1.97%, I think, on the long bond. The stack, as I call it, of negative yielding bonds made its all-time high that day. It was a number around 17 trillion. Also at that point in time, yield curves were steeply inverted. But let me put it in plain language like my grandma might understand. Back in 1981, during the Paul Volcker era at the Federal Reserve, interest rates got really, really high. We had, for instance, the government of Canada come with a 15% yielding bond in that period of time, and you just couldn't give it away. Nobody wanted it. Everybody thought that, inflation was just going to keep going up and up and up, and, we just had the gold market run to $850 an ounce and so on, and nobody wanted to buy these bonds. They would just be, turning to dust. I'm thinking that here we are, 38 years later, maybe the environment that we're in now is sort of the polar opposite of that. I mean, people wanted to buy bonds so badly recently that they were willing to buy bonds that guaranteed they would get less than their money back, buy them at a negative yield. So maybe it's the polar opposite, whatever. Leading up to that first trading day in September, the month of August, the bond market just kind of went no bid. I should say no offer. It just kind of gapped higher and higher and higher. It was perhaps a summer blow-off. You have to realize on a lot of trading desks, the big dogs are gone in August, and it's just the kids, running the desk. Any number of things. We had these prices of bonds run up sharply. Everybody was thinking, the recession is coming. The central banks are going to slash interest rates, are going to buy bonds, are going to take, the bond markets, particularly in Europe and into Japan, deeper and deeper negative, and so on and so on and so on. And then the market turned. Now, what was really neat about this was that it wasn't just the bond market. I mean, I saw the bond market at first, and then, when I've got part of my process is I go through my charts, all kinds of charts, all kinds of markets that I don't even trade, and I started to notice that a lot of things turned. Some things turned from, they had been going up, they started going down. Other things had been going down, started to go up, but a whole lot of things turned on or about the 3rd of September. So I called it a key turn date. And what that means to me is if a whole bunch of different things all turn or all have sort of the same inflection point, that makes it that much more important. That's why I'm saying, maybe it's the polar opposite of where we were in 1981. So here we are now. The sentiment seems to be maybe that recession has been kind of postponed a little bit. There's talk that, maybe taking interest rates deeper negative isn't going to work. We've got a new head of the ECB, Lagarde, that's taken over, and she's certainly been making noises that she thinks, in a way, and this is going to be just, too coarse, but it's kind of gives you the big picture, that the central banks have done what they can do. And now it's time for the governments to step up with fiscal stimulus. Whether that's right or wrong, whether or not it'll happen or whatnot, there's more of a listening to that point of view right now. And if in fact that's the case, then you can expect lots more bonds to come to market, and the fact that the central banks aren't there to buy them might push yields higher. This could lead to MMT money as we go forward from here. And then another side, people who invest in bonds need a return. Anyway, I think something important happened on September 3rd that all of these different markets kind of turned on about that same day. I don't think you really need to be able to pin down why. You can have an opinion about why that happened, but if you just notice that it happened across a lot of different markets, and you can, then you start to look for, well, what's the trade based on that?
The major stock markets around the world have had a strong rally for the past 6 weeks or so. Why is that? And do you think it's going to continue?
I remember, in, what was it? I guess it must have been the beginning of October. We were right in a low on the stock market, and the market started to come off the lows. I remember talking this over with my son, Drew, who works with me, and I said, something? If this stock market goes up and makes new all-time highs, that's really going to surprise a lot of people. And I know that a lot of the professional money managers out there in the world, a lot of them have been kind of cautious, and I think with good reason. There's a lot of reasons to be cautious. But if these markets break out to new all-time highs, some of those guys are going to effectively be forced to buy stocks or become less cautious, or they're going to have people that have got money with them take the money away. In other words, they've got a risk of losing their assets under administration, as they call it. Why has the market gone up? In coarse terms again, easier central bank policies, a lessening of trade tensions, and it's almost unbelievable how much the market, like a schizophrenic, is going one way or the other on, the latest tweet about trade tensions, but that's the reality. There's this FOMO factor, the fear of missing out that I just talked about, and then there's the TINA factor, there is no alternative. What are you going to do? Put your money in bonds here with a 0% yield or, that sort of thing? So the stock market has been bid and its momentum, and there's been rotation and all of that. I saw a little item on one of the websites I pay attention to that the S&P 500 index has gone up for 25 days without having any 2 days back-to-back that were lower. And that's the first time in 7 years that's happened. I go, well, that's interesting to know, but maybe just another little bit of a support for the idea that this market has been fairly aggressively bid. On the fear and greed index, we've got extreme greed right now. The S&P index itself, the distance that it is above the 200-day moving average is huge compared to where it typically is. We've got DMARC exhaustion levels, a technical indicator that would say the market's overdone. So for me, I am not long the market here. End of last week, I bought some sort of deep out of the money puts. They were dirt cheap because volatility's just been crushed. And it's sort of my toe in the water in the event that this market does take the escalator or the elevator down. We have a hard break here, and because I typically will not try to just step in and sell a market because I think it's overvalued. That's just not a good trading strategy for me. But I just kind of had to put the trade on, so I've kept my size real small on that, and I've definitely got limited risk on the trade.
We'll have more with Victor Adair right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. surrounded by world-class gold deposits and mines. Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Victor Adair. Victor, you've been consistently bullish on the U.S. dollar for most of the past 2 years, but when we talked a month ago, you had bought the euro against the U.S. buck. Have you changed your bullish U.S. dollar view?
On a longer-term basis, no. And yes, a month or so ago, we'd had the euro, I think at the end of September, had traded down to forgive me, about a 2-year low. It started to get bid a little higher. As a tactical trade, I took a long position in the euro, made some money on the trade, and then went to the sideline. And since then, I've been back trading the U.S. dollar to go higher, other currencies to go lower. Now, other currencies. There's a range of currencies out there, and I don't know if I've used this term on your show before or not, but let me introduce it. I call it the stealth strength of the U.S. dollar. When we're here in Canada, typically we're seeing the U.S. dollar vis-a-vis the Canadian dollar. If you're trading foreign exchange, generally, one of the first things you look at is what is the U.S. dollar doing against the euro, against the British pound, the Swiss franc, the Japanese yen, that sort of thing. I've been looking at what the U.S. dollar is doing to what we might call emerging markets around the world. And it's been stronger there. And particularly what I've been doing lately is looking at the U.S. dollar against pretty much everything south of the Rio Grande. Okay, we've seen set aside the weakness of the Venezuelan currency, the Argentinian currency. But lately, Brazil and Chile, their currencies are getting hit. And, but interestingly enough, over the past 6 weeks or so, the Mexican peso has been bid higher. And I was thinking, I wonder if there might be some Latin American contagion from those other countries come into Mexico. I've seen the Mexican peso go up. I've seen the bullish view on the peso in terms of open interest in the market. It looks to me like people are buying the Mexican peso kind of aggressively. And if, in fact, some of the social unrest that's getting manifest in some of the other Latin American countries was ever to come into Mexico, I think the Mexican peso would be vulnerable to falling against the U.S. dollar. So, in a big picture way, I keep talking about over time, capital comes to America for safety and opportunity. And then on the other side, when the market's feeling like they want to take on risk, capital maybe goes out from the United States and gets invested in countries that you might not normally even think about because, it seems like there's opportunities out there. So there's that kind of flow, to safety and then away from safety, sort of chasing maybe riskier opportunities. And, I think right now there's looking ahead at least, I think the market's going to err on the side of the United States is maybe a safer place to have your money. They got the problems too, for sure. The key thing to remember in trading currencies is the least ugly wins.
Of course, we're wondering if we're going to see $8 cauliflower again this Christmas. The Canadian dollar's been in a narrow 3-cent range this year. It's, if anything, drifted a bit higher than the 73.5 cents it hit last December when crude oil and stock markets were down. What are your thoughts on the Canuck buck right now?
Actually, there's not a lot to think about with Canada. And you're right, we did hit a low last December, and certainly people that are active in the markets will remember, through November and December, the U.S. stock markets got hammered. The crude oil price dropped from about $75 to about $42. Canada made at least I think a 2-year low at that time. There's different things that impact the value of the Canadian dollar. Certainly, sort of leading the pack is the relative strength or weakness of the U.S. dollar. So if the U.S. dollar is being pretty aggressively bid against most currencies, the Canadian dollar is probably weakening. The interest rate spread between Canada and the United States is important. And then, generally speaking, where commodities are. If commodities are in kind of a bull market, you go back to, say, from 2009, 2012, commodities were bid. The Canadian dollar got bid as well. And then from time to time, there'll be, call it a special situation, like when Trump was trying to renegotiate NAFTA. The thought that maybe NAFTA would get thrown in the garbage can, sent a shiver through the Canadian market. Recently, since we talked last, we had the federal election here. That did absolutely nothing to the currency market. So the results of the federal election then had been priced in, as it were, to the level of the Canadian dollar. Since we talked last, the Bank of Canada had an important meeting. They decided to do nothing in terms of changing interest rates, although the signals from Polos in particular were that, they're watching, and there's a lot of things to be concerned about, especially outside of Canada, that could impact Canada, and the feeling was that it wouldn't take much for them to move to cutting interest rates. So that put some downward pressure on the Canadian dollar. Canada then, I think, has got a little bit of a bid here in an environment where the stock market indices around the world are going up. Certainly in the United States, the major indices are all at all-time highs, and I think even the TSE index has just hit an all-time high today. And rising crude prices, that gives Canada a lift when we look at it vis-a-vis the United States. So I don't have a strong opinion one way or the other on Canada. I think it's maybe at risk of sliding a little more from here. If I had to put a trade on, I'd probably trade it from the short side, but at the moment I'm just kind of neutral on Canada. It's like there's better things to do elsewhere, and I don't want to get distracted, I guess, is maybe what I'd say about Canada.
We'll have more with Victor Adair right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, the gold market hit a 6.5-year high at the beginning of September at around $1,560 US. It's now about $100 lower than that right now. Why do you think it's gone down, and do you see it going higher from here?
Well, the gold market has absolutely fascinated me, I'll tell you that. And gold was one of those other markets that pivoted right on what I call the key turn date, as we talked about at the top of the show. That it was like that day or the next day that gold made that high and has subsequently backed up. What drives gold? The gold salesmen of the world that are out there like to use fear and all that to tell people, if you don't own gold, you're going to risk losing everything and so on. Let's take it a step above that kind of analysis. Typically, the gold market will move opposite of the U.S. dollar. When I say typically, if you go back over the last 25 years or so, if the U.S. dollar is kind of weak, then gold is kind of strong. Okay, there's that. There's other things in there, and one of them that have been, I think, not seen as much as the relative strength of the U.S. dollar is interest rates, particularly real interest rates. And real interest rates are the rates you get after you strip out inflation. So if the real interest rate is 4% and inflation is 3%, then the real rate is 1%. And lately, we've had a lot of real rates below zero. So in an environment where real rates are low, particularly if they're below zero, that's generally seen as a good environment for gold. So I'm going to propose to you that from the lows of November or so of last year to the highs of September this year, gold rose $350 an ounce. That's what happened. But I'm going to say that I think one of the key reasons that happened is because interest rates were so low and or negative during that period of time was a big boost for the gold market. The U.S. dollar, strength or weakness, actually, I think, had relatively little impact on the gold market during that period of time. Interest rates were just so important. So there you get this rally in gold. And as much as a lot of the keen guys in gold out there, and I have been involved in gold for 50 years. I've traded physical gold, I've financed gold mining companies, I've certainly traded a hell of a lot of gold futures and options. I think I know something about gold, but the people who love physical gold kind of talk about with disdain about the futures markets. You know, they call it the paper gold market. I understand that. It's not real gold. A bar of gold in your hand is a whole different thing. But the price of gold gets determined by that darn paper market. And the guys in the paper market, in the futures market, a lot of them that are in there are using huge leverage. So when the gold market goes up, they're making out like crazy, you know, and if you're in a market that's going up and you're making out like crazy, the temptation certainly is to buy more of it. So as the gold market had this rally, we saw what we call the open interest. That's the total number of contracts that are open in the futures markets went to an all-time high. And the bullish positioning of the speculators went to an all-time high. So here we've had this market's had a great run, and now the people that are at the margin of creating the price in the futures markets are in effect all in, and then interest rates tip over and start to go the other way. And I said to myself, this market is really at risk of having a break. If interest rates keep backing up or rising the way I think they are, a lot of these guys that are into the gold futures market may be right up to their eyeballs, you know, with leverage, may be forced to start to liquidating some of their positions, or the margin clerks will drag them out. So I've been trading the gold market largely from the short side. I've bought it a couple of times here in the past couple of months. I think it's still at risk, but I don't want to go into an in-depth conversation here about open interest with you. Put some folks to sleep. But people that want to know more about that, take a look at my latest blog, the November 9th one on my trading desk notes, and I'll give you there's some really interesting information there about what the open interest in those spec positions might be doing in the gold market.
Crude prices fell nearly in half between October and December last year, hitting a low of around $42 around Christmas. The current price, about $57 a barrel. You told us before that crude prices often go up and down with the stock market. Do you think with the stock market going to new highs, it will pull crude prices up?
I think it has to some degree, and yes, for sure. Over time, I've seen crude oil and crude oil and the stock market sort of turn more or less at the same time. We certainly saw it about a year ago now. It was in October that both crude and the stock markets made a high, and then they both fell sharply into the Christmas low, and then they both rallied out of that. I mean, just as an example. But certainly so far, the crude rally off the lows we had, even go all the way back to last December, but just lately, let's say since the beginning of October, when the stock market was in a bit of a hole and now has rallied to new all-time highs on the leading indices, the crude oil is up, but not nearly as much. I think the crude oil has been struggling a little bit with the supply-demand picture. We've certainly seen this huge increase in U.S. production. I think U.S. production has about doubled, and forgive me if I'm doing this by memory, but it's in about the last 5 years. Went from about 6 million barrels a day to over 12 million barrels a day in domestic production. I mean, that must have really thrown a monkey wrench into the guys at OPEC that were trying to manage the amount of oil that was out on the market. So and also, some of the people that keep track of these things, like the Energy Commission, that's not the right term, but when they're looking at demand, with this idea that maybe there is a global slowdown and that's going to dampen demand and so on. Previously, the market had been just, I think, so focused on the supply side. What's OPEC doing about cutting back, or somebody trying to sneak some production out the back door, that sort of thing. And now I think it's more even, where the market's concerned that demand is not as strong as they thought it was going to be, and if there's any further recessionary trends, demand could fall off. So, yeah, crude's kind of struggled here relative to the stock market. Do I think it's going to go up and make not new all-time highs, but let's say take out the highs of last year? No. And the highs of last year, about $75. Not in the next couple of months, unless we get some sort of exogenous shock like we had when those bombs went off at the Saudi oil facility. So, yeah, I don't really have much of an opinion on crude. Again, I'm finding maybe other more interesting things to do. It is a little stuck here, and sometimes you gotta trade the things that where there seems to be more opportunity.
Victor, you've got about a half a century of trading experience under your belt. Do you have any key rules or methods that you stick to guide you?
Well, half a century, that's a tough way to put it. I mean, but you're right. I started, it was just about 50 years ago, trading penny mining stocks while I was going to university, and I had about $7 or something that I could invest in those days, because you're just a starving student. But I certainly have learned some things since then. I tell you one thing, I think that's so important if people want to be trading their own account. And I can't imagine not trading your own account. I mean, I personally couldn't imagine just giving my money to somebody else and have them trade it. But then at the same time, I don't have a problem going to a dentist or a doctor and doing what they tell me. I think the successful folks that I've met, and I've met a few that have done really well, somehow find a way to trade or participate in the market that suits them. And let me say it this way, for years I'd say to people, well, I'm a poet, not an engineer when it comes to trading. I'm not one of those guys that wants to have all kinds of spreadsheets and, account for everything. I'm much more of a, what do I see on the charts? What do I feel in terms of, is this market aggressively bid or aggressively offered? That kind of thing. Now, the thing about that, in terms of finding a way to participate that suits you, you change over time. The markets change, and you've got to change as well. I'd say recognizing truly who you are. I mean, I like to call BS. I like to fade the crowd. With the stock market here printing new all-time highs, I'm sneaking a little, limited risk short positions in there, saying this thing looks like it's priced for perfection. The least little thing goes wrong, and the market could move the other way, and I'm going to make a buck. You have to have a process of some kind, and if you can't kind of write down your process, pretty, paragraph or so, you don't have one. You have to have a plan, I think, on what you're going to do if. One of the ways I like to get into a market, I'm looking at markets ahead of time to say, well, I don't want to do anything right now in this market, but if such and such happens, then this is what I'm going to do. I'm going to step up. And you want to kind of have that ahead of time, rather than you're looking at things and say, oh my gosh, look at that's happening. Gee, I wonder what I should do. That's no good. You want to be ahead of that. And one last thing before I could spend the rest of the afternoon on this, but one last thing. For me, one of the things I've always said is, it's only a trade. Whatever your latest brainwave is, you think gold's going up or the stock market's going down or whatever, and you want to put a trade on, don't get married to it. It's just a brainwave you had right now. Chances are you're going to lose money on it. Maybe you make money on it, whatever. You need to be prepared for either of those things to show up. I would say that the guys that I know that have traded for years and have done well will tell you that all the money they made from trading came from maybe 10% of the trades that they did. In other words, the 90% other trades just were winners and losers that kind of offset one another. You kept your hand in the game. But if you didn't have those 10% of the total trades on, you would have never made any money. So therefore, you got to be quick, I think, to get out of a trade when it's not working, and you got to try to be patient with a trade that is working.
Victor, thank you so much for chatting with us.
As I say, Jim, it's always a pleasure. I look forward to talking with you again.
My guest has been Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. Check out his website, polarfuturesgroup.com. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.